Welcome back. Those are Dr. Reddy's numbers flashing on the screens. The profit figure is, of course, much better than anticipated. Revenues more or less in line. We'll put up the EBITDA for you in just a moment as well. That's revenue. So revenue is more or less in line. Just
I think the numbers are ahead of estimate, so it'll be quite a bit, especially on EBITDA
the
front.
EBITDA front, I think.
The EBITDA, I think, has beaten the estimate quite a bit. In fact, it's a very good set of number that you have from Dr. Reddy's. So that's interesting. I think the only issue with Dr. Reddy's is that now it's at fresh 52-week high. I think it will be fresh, multi-year high for Dr. Reddy's. It's a stock which has done well, of course. So how much of this was in the price, we'll find out with the market's reaction. But for now, the stock is still higher by about 2%. So let's see. The market also now trying to recover a bit. Reliance is helping. We spoke about Axis. I think Reliance, ITC, a couple of stocks which are trying to bat for the bulls. And of course, the big mover has been Maruti. That's been up through the day. Saurabh Mukherjee, founder of Marcellus Investment Managers, is with us now. Saurabh, hi, good afternoon.
Good afternoon.
So, the market's very volatile, as would be the case with any union budget. But your thoughts and your verdict?
I think, look, along expected lines, I think the finance minister is a rank-holding CA. So his political skills and his accounting skills are both in full display here. He's, I think, played to every segment of the electorate you can imagine. The farmers, the informal sector workers, the middle class. The only sort of the dark cloud, I would say, is the fiscal arithmetic doesn't seem to be quite as comfortable as I expected it to be. So the 3.4% deficit numbers he's pointing to, anywhere between 0.5% to 1% of spend seems to be camouflaged somewhere. Now, whether it's Food Corporation of India spend, left pocket to right pocket, we'll have to look at the fiscal arithmetic. But this is par for the course in a pre-election year. Who's going to give you all who's going to announce a real budget deficit? But barring that element, and barring, I suppose, a reduction in post-election capex, because if you have a higher spend number on pro-poor spends, you're going to pull back spend somewhere.
Capex.
Barring that, along expected lines, smart pre-election budget.
But, let me try and bat for the other side, if I may. This farm income scheme, the basic income scheme that's come in, so they've budgeted around 75,000 crores for next year. That's lower. I mean, people were going with all kinds of numbers, 2 lakh crores, or, whether there'll be something which could cost as much as 3 lakh crores. So compared to all that, this seems within reach. And how would you sort of look at its ramifications for consumer, specifically for staples? And would that not be a good boost for at least that part of the market? So,
Surabhi, I agree that the farm income spend number, I would say that the outlay is around 0.3% of GDP on that, the PM Kisan piece. I think the joker in the pack, and I think this is an unexpected announcement, is this mega pension yojana. Because if you do pension maths in India, and one rank, one pension is an example, the FM himself cited it. The spend on one rank, one pension is around, I think, spiraled 50 times in the last 5 years, right? So whenever you do pension yojanas in our country, numerous claimants emerge, and there's a real risk that this will spiral up after the election. If you add the two together, PM Kisan and the one rank, one pension, you're probably giving a fillip to consumption of around 0.5% of GDP, which is why I'm suspecting that capex will get pulled back in the remainder of the fiscal and the next fiscal. Consumption gets a further boost. Yes, on the stocks front, you're right. Consumption stocks get a further boost if they ever needed one. FMCG volume growth was already 11, 12, 13%. It probably now heads into the high teens.
So, sort of the interesting bit then, from here up until election, how do you approach market sectorally? Still be reluctant bull on FMCG, consumption, IT, or look at other sectors there?
A couple of things. I think firstly, FM, I think, wanted to reinforce this fiscal consolidation message, right? So he played that point up repeatedly. Whether genuinely there's fiscal consolidation or not, who knows? But I think he set the stage for a 50 bips RBI rate cut. Given where CPI inflation is, food inflation is, given what the Fed has said, I think it'll be very difficult for Shakti Das not to cut by 50 bips. I think that's a major pre-election trigger. That apart, it's always sensible in India to think of 2 to 3 year runs. As I've been saying on your programs for the last 4, 5, 6 months, not just IT, which I advocated 1.5 years ago, even pharma, I think, makes sense. It'll benefit from the pro-poor spends. It'll benefit from the weak currency. And Dr. Reddy's, as I've said repeatedly, is my top pharma pick. Private sector banks. There's nothing that I'm seeing which suggests that the problems of the NBFC and HFC sector are at an end. private sector banks will do well as we get more rate cuts. I think banking, especially private sector banks, becomes a nice place to be. Consumption carries on booming. There's never a challenge with a consumption boom in our country.
Sure. So I'll come back to you, but Aditya, so is this market sort of running out of ammunition? It's been very narrow. One of the most bipolar markets that I've seen. A handful of stocks just carrying the market forward. The broader market has been quite dismal, advanced decline almost on a daily basis, well in favor of declines. Your thoughts on that?
No, I think this market has been getting narrower and it's going to stay narrow for a bit. I think the expectation that you'll get breadth when there is uncertainty of the nature there is at this point in time, I think is just running a little ahead of itself. So we've really been advocating a fairly defensive stance, both in terms of sectors and in terms of stocks. And I think the current environment, what you're seeing both from a market perspective and from an underlying economy perspective, basically suggests that you should actually continue to stay that way. So I think it is a challenge for the market that while everyone's looking at stocks to buy, the reality is it's a point in time where you need to be safer rather than sorrier. And to that extent, I think you will have to live with a narrow market at this point in time of the cycle.
Okay, so Hiren, in that case, if this is going to be a bit of a narrow market, a range-bound market, that also means, tough times for stock pickers out there. So what is the portfolio construct? What would you go with as we get into the next major event now, which will cause its own volatility, and that's the election?
There's never a dull moment for stock pickers, Surabhi. I think our view has been that the uncertainty of the elections, the time frame from February to April would be a good time to, to pick stocks. When everybody stays cautious, that's when the opportunity, comes to the fore. Mm-hmm. And we've seen this. This is not just this cycle. I mean, anybody who bought stocks, let's say in the second half of 2013, well into the first quarter of 2014, was a happy man in 14, 15, 16, 17. And why should it be any different in this election cycle? So I think markets move in cycles. It gets narrow, and then as confidence builds in and as growth kicks in, the breadth of the market improves. So I think, the way we look at it is that, Feb to April is a good time to build your portfolio. Again, portfolio positioning can be very different if you are trying to play a tactical event for a few months, but that's not what we do. You buy stocks to make money over a medium to long-term perspective, and sometimes you get great opportunities in sectors which may not be doing well in the short to medium term. And the key is to keep a balance. I think what's important is not to swing from one end of the spectrum to, either to be completely defensive or to be completely aggressive. I think, depending on where you see opportunities, I think if you construct a good mix of portfolio which has, steady compounders, and then there are stocks where the risk reward, where a lot of the bad news is already priced in, you hope to make decent money over a 3 to 5 year cycle.
All right.
And that's the way we look at building our portfolios.
Fair enough. Hiren got that. Thanks a lot for joining us. Aditya will thank you as well for joining us today on this big day. So, sort of the next question then, in that case, is it fair to assume that this is going to be a stock-specific market, not even sector-specific, at least up until May, June, and perhaps we'll have a second half rally in the stakes market towards the previous highs?
I would say it's beyond May, June as well. I think this is the fundamental problem is the market is overvalued. I think I've said this several times before. 9,500 is where I think the Nifty should be. We're clearly north of that. And until the semblance of normality resumes either on earnings growth or on market valuations, it will be a stock-specific market. Now, whether the market goes to normal valuations or not in the next 6 months is anybody's guess. Elections could be a trigger. So could be the shakeout that we are seeing in the money market in the housing finance sector. But my reckoning is unless either you pull the market back by 10-15% on valuations, or we see a resumption in earnings growth. Until one of these two happens, you stay stock-specific, and I reiterate IT, pharma, private sector banks, and small ticket consumption is where I would position the portfolio.
Interesting you say pharma. I'm just looking at Reddy's numbers. Their US business hasn't fallen as much as what was feared. They don't have too many product launches in the third quarter gone by. That stock's mildly positive, 1% up. But what within pharma? Because it's not an overarching theme that you can play, really, is it, Saurabh?
And I think Saurabh has said Dr. Reddy's is his top pick. But apart from that,
yeah. So I think you're playing two things here, Reddy's. One is you want to identify pharma companies with strong chemistry skills. I think Reddy's stands out, probably the strongest set of chemistry skills in our country. Secondly, you want to identify pharma companies who benefit from the slide in the rupee from 64 to 71. Remember, ultimately, both with IT and pharma, these are not particularly differentiated companies in the global context. And hence, what they sell is price sensitive. If the currency supports it by around 4% a year, they benefit. And hence, the rupee staying at 64 for 5 years pulverized these guys. Now that the rupee has started sliding again, just like with IT, but with a lag, I think pharma will benefit. So there is an element of science, element of chemistry skills. Reddy's is a classic example. Cipla would be another example. But there's an element of these are commoditized offerings. Currency sliding helps them stay competitive.
All right. Let's do one thing. We will take a break on that note. Saurabh, stay on. The market's off the lowest point of the day, but still down quite a bit. It's been a treacherous day if you're a bull, especially if you bought after the speech, because from the high point, the market's down quite a bit.